Tax savings is for everyone and not just the super wealthy. And in this video, I'm going to go over the 5 steps that we use with all of our clients to make sure they maximize their tax savings. There is a term that you might not have heard of called phorosophobia, and that actually means fear of taxes and the IRS. That's right, it's an actual fear. And if you think about it, most Americans actually fear and hate taxes. And there are a couple reasons for that. One, we are taught to fear taxes. The media tells us that tax law is unfair. It is only beneficial to wealthy people. So we hate and fear taxes. Growing up, our parents probably don't like taxes. And we might hear that in the household in terms of how when it's tax time, parents are unhappy because they have to pay money to the government. And also, guess what? You fear the taxes a lot of times from talking to your CPA. Yes, a lot of CPAs are fearful of taxes and especially of the IRS. So you'll hear a lot of CPAs talk about scary stories about audits and things like that. And so, from the media and our surroundings and maybe even our tax advisor, it's no wonder why so many Americans fear the IRS and hate taxes. But today, I want to change all that for you. We're going to talk about the truth behind taxes. But to start though, it is really important to understand that tax is actually our biggest erosion of wealth. What I mean by that is studies show that Americans lose more to taxes than we do on food, clothing, and housing combined. So pretty mind-boggling. For someone who makes $500,000 of year in income, after taxes, they're left with less than $200,000 of it. And so this is the reason why tax savings is so important, because taxes saved means more money for us to invest, enjoy, and what I always tell people too is saving taxes is the easiest money you'll ever make because you've already made it. It's now just about how to keep the money that you've earned. One of the questions I get a lot is, when is it appropriate for me to do tax planning? How much income do I have to be to actually start doing that? What type of income do I make? And the reality is, if you are a real estate investor or if you're aspiring to be a real estate investor, whether it's part-time or full-time in real estate, there are tax saving opportunities for you. And today I'm going to share a brief overview of the 5-step process that we go through with every single one of our clients to make sure that they maximize their tax savings. So let's get right into it. The first step in tax savings is to make sure you are earning the right type of income. Why is that important? Well, because when it comes to taxes, different types of income is taxed differently. Now, when we work, when we have our business that we're running, we are paying the highest taxes on earned income, because not only are we paying to federal and state taxes, we're also paying into payroll taxes, Social Security, Medicare, self-employment tax. And so that takes a big chunk away from our taxes. Of course, for every one of us, we want to start to build better income, passive income, income that you don't have to trade hours for. And when it comes to taxes, passive income is actually a great source of income because, one, you don't have to pay into Social Security and Medicare. So that's potentially 15% savings off the top. And when we have passive income like that, we can use rental losses that are passive losses to offset all of that income as well. So first step is to try to earn better income, and that could be from rentals, that could be from sale of a property, that could be from investing in a side business or a startup business that your friend or your family has put together. And so earning more passive income allows every one of us to use rental losses from depreciation and write-offs to offset all of those things. The second step in the tax planning process is write-offs. Once you're a real estate investor, you are a business owner in the eyes of the IRS. And yes, when I say business owner, I don't mean LLC or S corporation. I just mean you are in the business of rental real estate. So in the second step of the planning process, when we are a business owner, what we can now do is start to turn some of our personal expenses into legitimate business write-offs. Real estate investors, we're all really good at making sure we capture our mortgage interest and property tax and insurance or management fees. But what a lot of people miss out on are these overhead expenses that could be legitimate tax write-offs. So common examples might be car expense, home office, if you're traveling to a real estate conference, flights, hotels, meals. Those are all things that could be legitimate business deductions that can now offset all of the rental income, other passive income, and maybe even W-2 or other income as well. And when it comes to maximizing deductions, of course, as real estate investors, we can't forget about depreciation. Depreciation is the ability for us to depreciate or write off the purchase price of our real estate building over many years. What I love about depreciation is that there's so much flexibility in the tax law where we are not restricted to only depreciating a property over 27 and a half years. There are ways for you to supercharge or accelerate your depreciation, whereby we can take more write-offs up front in the first year, second year, third year, fifth year, and so on. And so with respect to planning, one of the things we look at when maximizing our expenses is just capturing what we're spending our money on and making sure we can legitimately claim those as business deductions and also optimally maximize our depreciation tax benefit. What's really interesting is in tax returns that we review, about 30 to 40% of returns that we see are not optimizing depreciation. So if you're a real estate investor, that's definitely a planning area you want to make sure is part of your process. Just in maximizing expenses alone, we see some pretty significant savings. One example is we have a client who is a high income earner in the medical field, and they have a spouse who is managing their rental properties full time. Well, through tax planning, they learned how to capture and maximize their personal expenses that qualified for legitimate business deductions. So they learned how to maximize their home office deduction. They learned how to maximize the car deductions for their real estate use. And they also learned how to put their kids on payroll so that they had their kids help out in the real estate and take a tax deduction for it. And through accelerated depreciation, this couple was able to save over $130,000 in taxes in the first year, just with a couple of single family homes. So you can see you don't have to be a super wealthy individual. You don't have to be a big time investor to get some of these life-changing tax benefits. All right, step 3 in tax savings is that you have to make sure you have the right legal entities. When it comes to rental real estate, it's actually pretty simple. If you have rentals, you're usually going to put them in an LLC or a partnership, not going to be inside of a corporation. I did a video on this, so make sure you check that out about what are all the different reasons why you have them in LLCs and not S corporations. And also my other video covers different things like what are all the steps that you should be taking before buying the property and after buying the property to make sure you're utilizing LLC correctly. But again, with respect to tax planning, the third step is just making sure we are operating in the right legal entities, because when you're in the right entities, like an LLC or partnership, you preserve all of those tax benefits. Alternatively, if you're holding your rental properties in a C Corp or an S Corporation, you might be limiting some of those benefits and not being able to capture all of those today when it comes to taxes. The fourth step in the tax saving process for any real estate investor is making sure you're investing in the right type of properties. And this is a really big one, guys, because different types of real estate, believe it or not, have different tax law. And yes, I'm talking about within rental real estate, there's different tax treatments. Why is that? Who knows? Politicians, Congress, they like to make taxes more complicated than it needs to be. So when it comes to rental investments, we have different types that we can invest in. Some common ones are long-term rentals. So that could be you buying a single family home, multi-family, self-storage, apartments, mobile home parks. Those are usually all within the long-term rental category. Now, you might be doing a BRRRR strategy, right? Buy, rehab, rent, refinance, and repeat. If you're doing that, those again, generally going to be long-term rentals. And now we're seeing a lot of people who are doing midterm rental. The midterm rental market is exploding right now. So midterm rentals from the tax perspective is treated exactly the same way as long-term rentals. So there's a couple rules we have to be aware of if you're investing in long-term rentals. The first thing is if your income is $150,000 or less, you may be able to use up to $25,000 of rental losses against your W-2 and other income for everyone. This is regardless of how many hours you're spending in real estate. You could just be working full-time and not doing too much with your rental properties. Now, if your income is over $150,000, then generally your long-term rental losses are considered passive losses, which means that they only offset taxes from your other passive income. So that goes back to step 1 when we're talking about let's make sure we make better income in terms of investment income, better income in terms of passive income, anything that we don't have to trade our hours for. If you're someone investing in long-term rentals, your income is over 150, usually the losses are passive losses, which offsets other passive income or taxes from future income that you'll generate in the passive side. Now, one thing, there's a loophole around that, which is if you or your spouse qualifies as a real estate professional, then those long-term rental losses can offset all types of income. And that's where you hear people say, hey, I made $300,000 of income, my spouse was a real estate professional, and I paid no tax. Usually usually that's the profile that they're talking about. And I did a video on all of the details of real estate professional status, so you can check that out. And also link below for my free tax savings toolkit, where we take a deep dive into what is a real estate professional and who can qualify for it. So that's for all of you who are investing in the long-term and midterm rental realm. But let's face it, not everyone is fortunate enough to be a real estate professional or can marry a real estate professional. So for those of you who are high income earners, or just two people who are working W-2 full-time and real estate is a side hustle, short-term rentals might be a good investment option for you. Why? Because when you invest in short-term rentals like Airbnb and VRBO, your rental losses could potentially offset your W-2 income, even though you're not a real estate professional, even though you are working full-time and real estate is just a side hustle. So that's the benefit of those of you investing in short-term rentals. As long as you meet one of the material participation hours requirements, your short-term rental losses can offset taxes from your W-2 income. And yes, you do not have to be a real estate professional. Real estate does not have to be your full-time job. And in fact, we don't even care how many hours you're working at your job, because that is irrelevant. There are 7 different ways to meet material participation for short-term rentals. The most common one is you spend at least 500 hours across all of your short-term rental properties. The moment that you and your spouse, if you're married, can meet 500 hours on the short-term rentals, now your short-term rental losses can offset taxes from your W-2 income, from your business income as well. So why is this important? Well, because in the tax planning process, one of the things we work with clients on is determining what should they invest in. If you're someone who's working full-time, real estate is a side hustle, maybe starting out in the short-term rental space will get you some massive tax benefits. Alternatively, if you're someone who is already in real estate, you're a realtor, you're a broker, you're a property manager, or you have a spouse who stay at home and managing your properties, then maybe the long-term rentals might be better. And also too, we want to look at where you're investing. If you're trying to meet one of those requirements that we're talking about to get these massive tax savings, well, investing in something that's close to you or closer to you, or investing in a property that deserves and requires a lot of time from you and or a spouse, then that could be easier for you to meet those specific hours. So step 5 in the tax planning process is tax-free money. When we talk about tax planning, we always want to look at, are there ways for me to get tax-free money, whether now or in the future? And tax-free money can come from a bunch of different sources. You know, tax-free money today could mean, how do I tap into the equity I've built up in my home or my rental property without paying any taxes through a cash out refi? Tax-free money could be, if I have a bunch of stocks in a brokerage account that's appreciated in value, well, instead of me selling the stocks and pay a bunch of capital gains taxes, can I pledge my stocks as collateral and take out some loans against it? That would also be tax-free money I can use to invest and grow my real estate. Or tax-free money might be talking about Roth IRA or Roth 401k money. You know, how amazing would it be if we had some money in a Roth account where I can then use that to buy a rental property, let's say for $100,000 or $200,000, and that's going to cash flow and grow for me tax-free for the rest of my life, where I don't have to pay any taxes on it? Wouldn't that be amazing? And so those are the kinds of stuff that we want to look at, because at some point, it's always beneficial for us to have a bucket of money that's growing for us tax-free. And if we can pass that down to the next generation, whether it's kids or grandkids or nieces and nephews, that is the best gift to receive. So if you have been told the narrative that tax savings is only for the super wealthy or only for people who own a real estate empire, you can see now that that's not always the case. The 5-step tax planning process is the one we go through with our clients, regardless of whether they make less than $100,000 of income or more than $1 million of income. The process is exactly the same. The rules are exactly the same. There's a saying that you need to learn the language of money to build wealth. Well, what we say is learn the language of taxes if you want to keep your wealth. If you like this video, be sure to like and subscribe and leave a comment below if you have any tax questions. And of course, check out my other videos on tax strategies for real estate investors.